Welcome to Central Bank Central. I'm Kathleen Hays, here in Philadelphia at the annual meeting of the American Economics Association, the AEA, here with a very special guest, Anil Kashyap. It's great to have you here. I had to come all the way to Philadelphia, and you had to come all the way to Chicago for your first time on Central Bank Central.
Thanks. Glad to be here.
We're very glad to have you. One of my favorite topics today, and I want to remind everybody that you are Professor of Economic and Finance at the Chicago Booth School of Business, and you're on the panel that's looking at the future of the Fed. And I want to get right to a very important point that just before the end of the year, you wrote an op-ed posted in the Wall Street Journal, Trump's risky game with the Fed. And this has become such a hot topic. Central bank independence, where is it going? What does it entail? What are the right issues to raise? What are the wrong issues to go for? So, simple question: how did central bank independence get to be such a hot topic?
Well, the president has broken a 20-year norm of criticizing the Fed and advocating for specific policies that have largely been off the table. You go back to the 70s and 80s, it wasn't unusual for the president or the secretary of the Treasury to say something about the Fed, but basically for 30 years, this has been off the table. And the idea has been, let these guys do what they need to do. And at times we'll be unhappy, but on average, we're going to do better by not interfering. And he's just destroyed that norm. And so I think that's raised the question of, is there any cost to this, or is it just other background noise or whatnot? But I think it's the president that put this on the table.
He sure did. At the same time, Biden is also looked at now, some of the things that he pushed for, and it's the other side of the coin, right? Mission creep, for example. And that seems to be a legitimate question to raise. Do you agree?
Yeah, I think that'll be something we talk about later today at the panel. But this question of where you want the central bank to really be completely independent and where it needs to take some of the objectives of the administration or the Congress's priorities into account is not an easy question. I mean, regulation is just so much more complicated than monetary policy in terms of the distributional effects and whatnot. So it's probably not surprising that you get some blowback over those questions.
Well, but what about things like, climate change and making requirements of banks? There's other things I think that the Fed seems to be a little bit less focused on, and where we see more criticisms there about, again, what moving ahead, what does the Fed need to look at? And again, is it beyond what the Fed really needs to do, which is, first of all, fight inflation, right? And second of all, have an economy that keeps growing, don't go too far. But do you think any of those questions are worth looking at again?
Well, okay, so financial stability is probably the third thing that the central bank needs to worry about. And what constitutes threats to financial stability is a judgment call to some extent. I don't think, climate change isn't going to imminently affect financial stability, but figuring out if the banks, the insurance companies, the rest of the financial system is set up to deal with a changing environment is probably a reasonable thing to investigate. That shouldn't be a primary focus, shouldn't take huge amounts of resources. But having some part of the government looking at what the financial system is doing with respect to funding climate transition is not a crazy thing.
Well, what do you see as something that's worth looking at now? And I'm sure, yes, this is a big, very important question for the future of the Fed panel. But what would be at the top of your list saying, well, here's something, getting away just for a moment, okay, Trump's done this, he's done that. What would you say as we go into this, next year, the next 10 years, whatever, for the Fed, needs to be looked at again, could be examined to say, well, maybe we could go forward, maybe we could change something?
There's all kinds of things. I mean, they haven't clarified exactly what their communication policy is going to be as part of the framework review. They left that unsaid. There are discussions about the size of the balance sheet and how that's going to fit in. I think their financial stability framework is pretty incomplete. They talk about it a lot, but when you actually look at what they do, there's not a well-articulated set of principles even that everybody agrees on, and there's certainly not a monitoring framework. So I think those things are all core central banking. They've got to keep dealing with the evolving nature of the financial system. So you take stablecoins and crypto and all of that. That's evolving, and they don't have a choice really. They've got to come up with some way of dealing with it. So there's plenty of things for them to look at.
Well, I'm glad you raised that, because I felt for the longest time that, there's someone on a motorcycle and there's a little sidecar, and that's my image, my metaphor for how banking and financial stability work for the Fed. They're mainly focused on monetary policy. That's mostly what the FOMC does, the 19 members, and of course bank presidents, FOMC is bank presidents and the board. But the point is, I guess, is that something you would say, another thing that could be looked at again? You don't need to go the road of the Bank of England and have almost a separate body to look at financial stability, but is that something the Fed taking on more than it needs to take on? There's lots of other regulators when it comes to banking. What would you see there?
Well, look, the Fed is in the end the lender of last resort. And so if you're going to have situations where the Fed's going to be making emergency decisions, it's probably not a wise idea to have them completely disengaged from the supervision and regulation of what's going on. So I think, that's kind of inevitable. They're going to, be there at the funeral, so you probably want them to know the patient. And so I think there is a role for having a central bank engaged in some aspects of financial stability. I think part of the problem that the Fed faces right now is they don't really have a playbook. So every time something comes up, it gets done on a slightly ad hoc basis, or they fall back onto something that they've done previously. So if there was, a facility to be set up, if they did it in a global financial crisis, well, then they know how to roll that out. If they need something new, it's clunkier and takes a long time. They tried to set up that Main Street lending program during the pandemic. It didn't really take off very much, but that was done new from scratch. And the oversight of that was a little funny because, who was calling the shots on that? If there were going to be loans made and there were going to be losses, how was it going to be accounted for? There's all kinds of issues that come up on the financial stability side that are kind of left up in the air in the American system. And some of it's because of the fragmentation you talked about, but some of it is they've just chosen not to really engage. So
I want to bring up a thing about, is part of this that the Fed does not like to admit it makes mistakes. We know it does. Who doesn't, right? For example, Charles Plosser, who was a very well-respected economist and a former District of Fed Bank president of Philadelphia, great supporter of Fed independence, by the way. He has argued, or did argue before we lost him, that the Fed needed to accept criticism. Why does the Fed resist admitting mistakes and push back against the critics? And again, this is Charlie Plosser. This is something he lived.
Well, look, they're going to get criticized fairly and unfairly, and I think there is a mindset. I don't necessarily endorse it, but there's a mindset that says, look, if we admit that we made this mistake, we're going to get beat over the head with it, and it's going to morph into saying, well, you've got no legitimacy, you've got no expertise, and just engaging in that discussion is kind of a slippery slope. I don't think that's the right way to do it. I think having these reviews after the fact and saying, look, we could have done this better is a completely reasonable thing to do. People can't expect them to be perfect. But it's natural not to want to be fighting from a defensive position, which is, I think, the way they view it. So they're getting criticized, I think, unfairly on a whole bunch of things, and so they would rather not get into some of these discussions of stuff where it's more ambiguous.
So give me a specific example of that, because as an aside, I will say, I remember when the new framework came out, I remember being out in Jackson Hole, and a lot of people thought it was a pretty milquetoast kind of review. They basically went back to 2012 with the first framework.
Yep.
And so again, give me an example where is that unfair? Give me an unfair example of criticism. And again, in this world, in this universe of the Fed, it seems to me you have a lot of smart people, and they're also passionate about it. In any kind of debate or whatever, don't you have to do that?
Look,
but
if you look at where,
example.
so look at where the economy was a year ago, just before this administration came in. The Fed had basically pulled off something it had never done in the post-war era, which was they got behind on inflation. They made a mistake for sure. They were late to get hiking, but the economy was on a glide path to basically hit a soft landing, okay? If you look at what the consensus was a year ago, and they had kept rates up, they've been beat up by this administration saying you should have lowered rates, where I think most reasonable people would say, look, were it not for the tariffs and some of the things that the administration's done, the economy was probably going to land pretty well, okay? You wouldn't know that from the discussions that we're hearing now, or that we've heard out of the administration, that the president has basically tried to extract a promise from whoever he appoints next to cut interest rates. And it's a pretty divorced from data view. Now, I think had the policies of the administration been different, they might have been able to bring rates down faster. But the fact of the matter is they ended up doing a pretty good job. I thought they would wind up with a recession when they started hiking, and that forecast proved to be wrong. So I think they deserve credit for getting to a pretty good place. Now, they've got a tough position at this point because they can't control some other aspects of policy. And the fiscal policy that they're going to be dealing with for the next few years is going to be very, very difficult. Mm-hmm. And that's outside their control.
Well, let's then focus for a moment on where the Fed is now and where it's heading, because they have started cutting rates.
Yeah.
And I do think some people are thinking, well, maybe it was a great opportunity for the Fed to cut rates and say, well, look, labor market's weakening. Inflation has been above target for 4.5 going on 5 years, mm-hmm. and they maybe they were sort of heading for a soft landing, but they haven't landed in that very important regard. So, in terms of what you think of this balance they have right now between inflation and the economy, and actually I think there's at least a couple of big firms on Wall Street who are looking for 2.5 GDP growth in 2026. I mean, the economy, what was the last GDP number? It was pretty healthy. So dive into that part of it. And again, very tough. And in fact, the Fed's very divided right now.
Yeah, I think because circumstances are pretty unusual. So you have a very loose fiscal policy. You have this immigration shock that it's hard to measure and quantify. If you look at financial conditions broadly, which is partly the way monetary policy transmission works, financial conditions are not that tight. And so I'm sympathetic to the view that we can wait and see for the inflation to come down. There are many people that say by the time we get to April or May, you're going to see the effects of the tariffs having kind of made the way through the snake, and the inflation going forward will look pretty benign. And at that point, I think it would be completely reasonable to cut interest rates a little bit more. But as you say, there are more and more people that are going to say, you're tolerating 3%. Mm-hmm. And if that's not really your target, then what are you prepared to do about it? So I think this idea of taking a little bit of a pause is a reasonable case to be made. And as you say, there's people inside the FOMC that are taking that position. There are others that think maybe you could cut a little bit more, but I think it's going to be a healthy debate. And it's super unfortunate that all the data got interrupted by the shutdown. I mean, that has definitely made things more difficult for the Fed to have to see through.
In your editorial, again, was a big hit, if in terms of people noticing, people wanting to hear more about it from you. And I think you did raise a lot of real basic questions and more subtle questions. But independence isn't an entitlement, you say. But is that the whole point? If it isn't an entitlement, well, then how does it insulate the Fed? I mean, again, the Fed needs to feel confident about making mistakes, making decisions, but there's still, I would think, say there should be some oversight on some level in the mix if it performs badly.
Sure. I mean, they have to testify and they have to explain what they've done. And, this is a case where, Congress has a role to play about asking questions. That I think Chair Powell's been pretty explicit, saying, look, we made a forecast error. We did not think we were on team transitory. That proved to be wrong. And as soon as we were convinced that it was wrong, we moved very decisively. And to their credit, they didn't cause a recession, even though I think if you polled most of the experts in monetary policy that are at this conference, I think the median forecast would have been there's going to be a recession, and probably it's a price worth paying to make sure inflation gets back under control and we have to relive something like we had in the 70s. And so that's a scenario that could have come to pass. They ended up not putting us in that position, and they should get some credit for that.
Well, what about the dual mandate? I think there's a view out there, a question out there about, okay, when Ben Bernanke finally got the 2% target in place, right, he had to then, because there didn't used to be a dual mandate, right? Under Volcker, under Greenspan, it was price stability. That was their number one goal. There was not really a dual mandate like that.
Humphrey Hawkins is 1978, and there's always been, in fact, there's a triple mandate because people don't talk about the low interest rates, which is also in the law. And the Fed has finessed that by saying, well, if we get low inflation, we'll have low interest rates. But that's been in there since 1978. Volcker took the view that the inflation was so out of control that you had to put that at the top of the list. But if you look at the way the Greenspan Fed navigated for 20 years or whatever it was, 18 years, he was very much balancing whether or not you were going to take a risk to try to let the economy grow. If you look back to 1996, for instance, a lot of people wanted to hike interest rates. He thought, no, we can grow without it. That proved to be a good bet. So the Fed's worried about this since more or less since the early 80s. And, if you look at the other central banks that don't have dual mandates, they all back into having some way of talking about that if the economy is very weak, even if inflation's a little bit above target, they want to have a rationale to let the economy grow or to keep interest rates low. So even places like the ECB or the Bank of England that have, single mandates find a way to say that the central bank has to also support the economy.
Another thing I'd like to, another op-ed sort of thing, I guess. I think Treasury Secretary Bissent wouldn't necessarily call it an op-ed. It was the big article in International Economy, right? Talking about the Fed's gain of function policy making. And again, this gets us into the question of what are you doing, why are you doing it? Is there mission creep, right? And there are former Fed officials, there's people, again, in this big Fed universe that would probably agree there has been something like that. But I'm sure you've read that one at least once. And was there any valid criticism in there? Or do you think that they're totally on the wrong track?
I think this question of how big a footprint you want the Fed to have in the financial system is a fair question. I don't fully understand what the secretary has as his counterfactual world. I don't think you can shrink the Fed's balance sheet back to the size it was in 2007. The financial system has evolved in ways that you just need a much bigger balance sheet. There's just a lot more demand for cash that we've got. So if you just look at the amount of cash, that raises the balance sheet. So I think you could ask the question of whether or not the securities that they own when they put these reserves into the system should be arrayed the way they are. Do they need to have the mortgage-backed securities? Do they need to have the longer duration assets on which they can take losses when interest rates rise. But I think the size of the balance sheet is probably more or less pinned down by doing responsible financial stability work. You're not going to shrink the balance sheet to $1 trillion or $2 trillion. It wouldn't work. It would be a disaster. And so I think there are questions you can ask of that sort. But this overhaul of we've got to get back to a very, very tiny balance sheet, I think is not really defensible.
Is there any grounds, this is a little more of an out there kind of thing, but should the Fed continue to help the budget deficit grow? If you buy all the kinds of securities that they want to issue, what if they suddenly wanted to double, this is an exaggeration, what if they wanted to double or triple the amount of securities they're issuing? That helps keep them financing a deficit that maybe they could be a little more selective about.
The Fed's not the marginal buyer of Treasury debt. And so the Fed's inconsequential at this point to supporting the amount of Treasury issuance. Now, it could come to pass in 5 or 10 years that the rest of the world has lost faith in the dollar or lost faith in the United States as a reliable partner and doesn't want to hold our debt. And at that point, maybe you're going to have problems because you're going to get an inflation risk premium built into the Treasury market, which then would probably percolate through the rest of the economy, make it more difficult for the Fed to keep the economy on a balanced growth path. And at that point, maybe they will be forced to buy more than they want to. But at this point, I don't think they're anywhere close to that threshold. So,
question broadly: fiscal dominance, is that where we are now?
No, I don't think we are. But if you take these extrapolations of, say, where the Congressional Budget Office thinks we're going to be in 10 or 15 years, that'll be a discussion that every Fed official that goes up to testify will say, well, what do you think about all this? So I think it's not impossible that we stay on this path and at some point we get into where there is an active discussion of whether or not the Fed needs to be buying more debt to cap interest rates or something.
I want to ask you about the Bank of Japan. That's another big area of your work over the years of the work you've taken on and what you've accomplished, because to explain to people, you can do it far better than I can, how their kind of or central bank independence works. It's not exactly like the U.S. And I think it's interesting, the idea that they don't have a voter from the government, but they do have a presence, and there seems to be it's more accepted that there's discussion, there's back and forth.
Yeah, so when the Bank of Japan, if you go back and do the history, up until about 1997, the Bank of Japan was more or less a creature of the Ministry of Finance. They didn't have anything that would look like independence. They were given independence, and part of the bargain when they were allowed to begin setting interest rates without direct instruction from the Ministry of Finance was that there'd be a government official that would be attending the meetings. And if you got to a situation where the government thought that the bank was going to make a mistake, the government could make a request to the Bank of Japan to say, we'd like you to consider this alternative policy. That happened once. Ironically, when Mr. Ueda was on the BOJ board the first time, and in that meeting, they adjourned. They came back at the next meeting and took up the question. And Ueda voted against the government, saying you're not allowed to interfere, that we should be allowed to do what we wanted. And then when it came time for the vote on the policy, he actually took the government's side and said, I'm going to dissent, and I actually think that was the right argument. I just don't think the government should be telling us what to do. So since that time, I'm pretty sure the government has never made a formal request, although the government did say that they thought that the inflation target 2 governors ago was too low, and there was actually a campaign, the Prime Minister's campaign was all around this idea that the Bank of Japan had to try to get inflation up. And so, the public spoke on that. They replaced the Bank of Japan's leadership and brought in somebody who believed in this idea of trying to get inflation up. And I think that's a completely legitimate thing in a democracy. So
sort of back to the Fed then, back to the president. Do you see any kind of shift here? Do you, with as this is a real kind of basic question, and I'm not a big geopolitics person, but Trump seems to be focused on well, obviously Venezuela. That just happened, the overtaking the leadership and putting the former head of the country in prison in the U.S. or up for a trial, whatever. But what I'm trying to say is, do you get any sense that maybe there's a shift of focus and interest here, that a lot of what's happening with Trump now when it comes to the Fed is talk? It's, oh yeah, I mean, maybe he just said this a couple of days ago, oh yeah, maybe I'll try to fire Powell before I leave. But does it, you think it has a little less intensity? Do you think maybe Secretary Bessent has sort of quietly kind of said, we're going to get what we want, you're going to be able to appoint a chair, but that, you know what I mean? Do you get any sense there?
I don't think it's very productive to try to model the president's behavior. It's pretty erratic. And just because it's been, calm for a week, it doesn't mean you should predict that. So you never know what's going to trigger him to go on a tweet storm about what the Fed should or shouldn't be doing. But I think for now, you could see that if things go as projected, he'll be able to nominate somebody in the next, I would have thought, week or two, and appoint that person at the end of January, and then be ready to be chair starting in May. And I think, if I was the president, I wouldn't be picking a fight over this. You'll get your choice, and then that person will come in and we'll have to try to convince the rest of the committee that what it is that he and she or whoever thinks is the right policy is in fact something that they can sell everybody else on. So let's see.
Do you have a favorite?
If you put a gun to my head, I'd bet.
Okay, here it is.
I think I'd probably bet that he'll pick Kevin Hassett.
Okay. Would you approve of Kevin?
Pardon?
Would you approve of Kevin?
I mean, he's well qualified in the traditional sense. Whether the markets are going to worry that he's been sent in to do the president's bidding is a tough question. We'll have to see. I mean, if he's nominated, he certainly could go up and testify, and he knows all the standard theories and evidence in favor of having an independent Fed. So if he does get appointed, he'd be wise to recognize that history's pretty clear on this.
Anil Kashyap, thank you for taking so much time out of a busy day here at the American Economics Association. It's a great event, and it's certainly great to have you on Central Bank Central.
Thanks.
I'm Kathleen Hays, in fact, and this is Central Bank Central.